Evening viewers. Today we are going to resume with our series, financial reporting, and our emphasis for today is basically we are going to look at the impairment of a cash generating unit, and we are looking at it having seen the first two videos that we did, and we looked at how we determine impairment an asset, and we also looked at scenarios where we had a revaluation gain in the previous year, and this year we are experiencing a revaluation loss, an impairment loss. We did that, and here is just a continuation of what excuse me, you may need to know as far as impairment of assets is concerned. And this is going to be all about impairment of a cash generating unit. And basically, when you try to look at a cash generating unit, it is just a terminology that has been given to a group of assets that we can't easily attribute individual cash flows to it. In other words, we can't easily determine cash flows or the value in use. We can't determine the value in use, and the only way we can do is by grouping these assets together as one asset, since we can't easily determine the amount of money that can be contributed by each item within the group of assets. This is just a continuation because we had done the first video which gave out the theoretical aspect, but here we are just giving us a precursor of what actually we discussed. But to make the thing very simple, to put this matter into something that is very lively, we may try to look at an example. If, let's say, we have a school and that school has buildings, and within those buildings we have chairs, we have chalks, we have all these small furniture that have been used by the school in order to provide education services to students. It becomes very hard to determine how much of the school fees that has been paid by a candidate that is going to be contributed by this building. If, let's say, maybe it is the building, you are trying to look at what is the percentage of the money we've actually received, and it has been attributed by the building or by the furniture, because it is hard to trace how much furniture contributed to the school fees someone is going to be paying. If, let's say, maybe you've been paying maybe tuition for CPA, you'll find that it is a bit hard. If at all maybe you are attending online classes, you'll find that they have a projector, they are using a computer, they are using a tablet, so that you can be able to receive all the information. What we are trying to look at here, all those items that are going to be used in the study, maybe online classes, you find that you can't estimate if maybe the whole tuition maybe for studying financial reporting is maybe $50. You may find that If someone asks you a question that how much is a computer, the computer you are using or the projector you are using, how much is it as far as or what is the percentage of the income that has been generated by the projector? What is the tuition they are paying? You can't easily identify the cash flows that are going to be belonging to that specific item. This means that these assets, they work as a team, and they be able to accomplish the work. Meaning, even the money we are going to be receiving, the cash flows are going to be attributable to a group of assets. So that's basically what we are trying to look at here. And if maybe another lively example is maybe if you are running maybe a restaurant, you find that you have plates, you have fridge, you have maybe oven, you have maybe even these small furnitures that have been used within the restaurant. So it will be hard for someone to answer a question that how much is furniture contributing to the money they have given you at the end of the day, or the money you earn, how much or what is the percentage that these furnitures are contributing to the money you are actually getting. It will be a bit hard. You find that if at all you don't have one, you can't operate. It means that these items, they work or they function together. Even the money you are going to receive, you receive it in a lump sum. You can't easily attribute one item that this one brought this and this one brought this. So that's basically what we are trying to look at here. And having understood that these items, we can't get their value in use. We said value in use is the present value of future cash flows, meaning you can't identify one item and you say that this is the cash flow that is coming from this one item. So if it is like that, it means we are going to be calculating the impairment as a group, or we are going to be getting a group impairment, and we'll try to look at some of these assets that we can't actually isolate their income or their contribution to the money we are receiving. So having understood that we are going to be receiving this money in a lump sum, and we are going to be looking at the impairment for a group, which we call a cash generating unit. What you have to understand is that when you are computing impairment of a cash generating unit, we have to compare the total carrying amount of the assets within the cash generating unit. If let's say these assets, we had maybe furniture, we had maybe computers and all that, plus the buildings, we add them up and we try to look at their total, and we compare their carrying amount. We say the carrying amount is the amount that is actually, those are the figures that are within the balance sheet. So when you try to compare all those figures, the total of the carrying amount with the recoverable amount of the whole figure of the cash generating unit, they will give you the recoverable amount of the cash generating unit. And you will also be needed to calculate the total, if at all it's not given, you calculate the total carrying amount of the cash generating unit. You compare that and you'll be able to see whether the asset is impaired or not. Because we said an asset is impaired when its carrying amount is higher than the recoverable amount. In other words, the money we are to get, if at all we are to sell these assets, is less than the value or the carrying amount as at the time we are selling them. Meaning, if you are to sell them, you recover less than their value. That's basically the implication of That's when we are going to be having an impairment loss. And within this cash generating unit, we try to look at 3 steps. One is that we try to look at the total carrying amount of the assets in the cash generating unit. Then the second item is that we try to look at the total recoverable amount of the cash generating unit or the group of assets. Then the other one we look at is now a comparison whether the asset is impaired by trying to comparing the carrying amount of the CGU or the cash generating unit and the recoverable amount of the cash generating unit. When we have done that, then we look at now the impairment loss we've computed, and we try to make sure that we allocate that impairment loss in the following order, which I'm going to give you. There is an order we follow of how we are going to be able to allocate the impairment loss of a cash generating unit. And we said one of the items you start with is if there are any damages or destroyed assets. In this case, you find that the asset has completely gone off. Maybe the asset had an accident and it completely crashed down and you can't recover anything from it. So that's what we give as our first priority. Then the next one we'll go to the goodwill that has been given to the cash generating unit. If there is any goodwill, then we are supposed also to write off the goodwill. Then the last one is now the balance. We try to look at the balance that has remained on the impairment. If let's say we had impairment loss of maybe 10 million, but we had maybe an asset of maybe 2 million or 5 million that was completely damaged. What we do, we first remove that 5 million, then the balance of 5 million that is going to be remaining as the impairment loss, we remove on that balance, we remove again if there is goodwill. If maybe the goodwill was 2 million, we remove the 2 million and we remain with 3 million. Meaning these 2 million plus the other 5 million of the damaged asset, they have now been written off from our impairment loss. Then the balance is what we use to allocate to the remaining assets on a pro rata basis. A pro rata basis, it means we take the total of those values that are remaining or of those assets that are remaining. We get their sum, their total. After getting the total, then we start getting the individual item over the total. Then we multiply by the remaining impairment of 3 million. Based on that example we have given, we do for each and every item, excluding some of the items that are supposed to be excluded when we are computing impairment losses for cash generating unit. And for the scope of financial reporting, we are mainly going to be focusing on 2 items. One is inventory, and this inventory, for it, we don't include it in our computations for impairment losses, because when we're doing IS2, we try to value subsequently, we try to value inventory at the lower of NRV and the cost. It is the lower of cost and NRV, or the net realizable value. So when we try to look at the lower, we make sure that whenever we go to the income statement, we less the changes or the loss in inventory. And that loss in inventory is always deducted as an expense. So if at all we have given that loss and we have already shown its treatment as far as the standard of IS2 is concerned, then when it comes to impairment, we are not supposed to compute impairment for it. Then the other item we can talk about is accounts receivable. These accounts receivable, those are the debtors, the one we have at the end of the year, or that are remaining, that are still outstanding for the year. Then what happens with those accounts receivable is that whenever we have, or whenever we expect, we suspect that some of these debtors, they are not going to be paying, we create a provision for bad debts. And that provision for bad debts is deducted as an expense in the income statement. So if it is done like that, then it means whenever we come to impairment, we are not supposed to reduce the accounts receivable figure, because we have already taken care of it under those provisions for bad debts that we provide. Because basically an impairment loss is just a reduction in the value of an asset. Because you can't, since we have already reduced these accounts receivable with the figure of provision for bad debts, then at the end of the day, we are not supposed to be giving it an impairment loss, because we are going to be double deducting. Then the other thing that you will find at advanced financial reporting, those are the non-current assets that are supposed to be, that are sold in the normal course of business. Then we have these financial instruments, or that even assets arising from employee benefits. Those ones we shall look at them when we go to advanced financial management. But even if they come here as items, make sure where there is impairment, you put 0, or we don't subject them to impairment, because other standards have already taken care of them and we can't double deduct their amounts. Actually, that's basically the precursor what we can have as far as what we did and as far as cash generating units are concerned. So basically, if at all you have not got it clear, you may try to review the first video we did. It was actually giving the theoretical aspect in regards to the whole standard of impairment, that is IS 36. And for now, let's try to look at this simulation 7, and we'll see how we can be able to put all the narrations we've been discussing into computations. So let's try to go through the question and we'll try to see what we can do. I abbreviated this CGU as to mean a cash generating unit. So it says a CGU comprises of the following assets. We have the assets, we have their carrying amounts in millions. I said I didn't put the currency signs in most of my tutorials because people are watching from different locations. So you may use any currency you want, so long as you get the basics. That's very important. We have the buildings at 320, we have the motor vehicle, 40 million, we have plant and machinery, 60 million, we have goodwill, 80 million, we have inventory of 200 million. When you try to get the sum or the total, it is 700 million. The question says, during the year, one of the motor vehicle with a carrying amount of 20 million got involved in an accident and got totally destroyed. An impairment review estimated that the recoverable amount of the CGU, that's the cash generating unit, to be 550 million. Show how That's the required. Show how the impairment loss will be allocated to the CGU. And we have also a trial number for October 2021, question 4. You may try to look at it. So let's try to go to Excel and we see what we can do. Basically, we try to add in something as far as because I'm very sure if we try to do the computations, we'll be able to pick a lot than basing on the theoretical aspects. So let's load an Excel. Okay, Excel is okay. But now maybe to analyze, we are seeing that we have carrying amount of 700 million. Recoverable amount we have. The recoverable amount we have 550 million. And we are seeing when we try to less that, the 700 minus the 550, we get 150 million. So our impairment loss is going to be 150 million. So we are going to be, my emphasis here is to make sure you know how to allocate the impairment loss, because computing impairment loss is okay. It's mainly what we started with, but my emphasis is on allocation of the impairment loss as far as the cash generating unit is concerned. So let's go to Excel and be able to see what we can do. So we have the carrying amount. Let's try to summarize the information. Carrying amount. Carrying amount, we have it as carrying amount of the CGU. CGU, I mean this CGU is a cash generating unit. Carrying amount is 700 million. Permit me to use M, not write the whole of the figures. Then our recoverable amount. Recoverable amount of the CGU is 550 million. Remember we said whenever you're comparing, whenever you're determining whether an asset has been impaired, you compare the carrying amount and the recoverable amount. But we said the recoverable amount is the higher of the two things, the value in use and the fair value less cost to sell. But here, our challenge is we can't determine the value in use because we can't clearly estimate the individual cash flows. That's why here they will always give you the recoverable amount, but the main emphasis is to show how you can be able to allocate. So now we are seeing that the asset is impaired and the impairment loss is 150 million. It comes after deducting the 700 million, we less 550 million. This will give us 150 million. That's the impairment loss. Actually, things as we discuss them, that's how you you narrate to them. If you are just computing these figures, you will not be able to score all the maxes. Like the way we've computed this 150 million, you'll go ahead and put some writing, at least to explain to someone who doesn't actually understand. You try to explain that the asset is impaired or the CGU is impaired since the carrying amount is higher than the recoverable amount. Actually, let me put it there so that you'll be able to follow that the CGU, I said the CGU is a cash generating unit. The CGU is impaired since the carrying amount is more than the recoverable amount. The recoverable amount. And you may go ahead to put in something in excess that the impairment, of course, we have already computed the impairment. You say the impairment loss of 150 million will be allowed. Remember, this one is taken to the income statement, will be allowed as an expense, in the income statement and allocated to the assets. And allocated to the assets in the order actually that very order we discussed above. We said one, start with the damaged products, damaged or destroyed, damaged assets, damaged or destroyed assets. And the second item we start with, we go next is the goodwill of the CGU, then other assets. Of course, other assets, they allocated other assets on pro rata basis. That's basically what we were supposed to do. On pro rata basis. That's what the standard expects us to do. So we can try to put in like a small table here and try to analyze the information we have. We are going to put this as we have the assets. When you have the assets, then we are going to be having the carrying amount. Their carrying amount. Then the next one, we are going to be having the impairment loss. Impairment loss. Then we also look at the carrying amount. Now this one is going to be carrying amount after impairment. Meaning these are the figures we are going to be taking to our balance sheet. We have assets, we have the buildings. Can go in their order. Okay. This we have the buildings. Have the buildings. Have the motor vehicle. We have plant and machinery. Let me call it them PPE. Permit me to use PPE, plant and machinery. Then we have goodwill. Goodwill. Then we have inventory. Of course, the last one is our totals. Totals. Total. The carrying amount for building, they gave us 320 million. Going to be using those, but just not all the figures are in millions. This one is 40. And plant and machinery, we have 60. Then goodwill is 80 million. And our inventory is 200 million. When you sum them up, we have 700 million. So we try to look at now the impairment. The impairment loss is now what we are going to be dealing with. If you try to look at this question, when you go back to the question says during the year, one of the motor vehicles with a carrying amount of 20 million got involved into an accident and got totally destroyed. We said we start with those destroyed assets. Now the asset that was destroyed is worth the carrying amount. Remember, we are taking only the carrying amount of the asset. The asset was 20 million. So we may put it in the bracket because we are going to be lessing it from here. It is 20 million. But remember, these assets we had a carrying amount, all of them had a carrying amount of 40 million, meaning some of the assets are still there, so we have to add. But what we are going to be adding from here, we will get it from the pro rata basis. Because what will remain here, it means that asset is still okay and is still functioning. So it means the remaining here of 20 million, they are going to be allocated in the pro rata basis because they are going to be okay. Then the second item, of course, we look at the goodwill. The goodwill had 80 million. We remove that 80 million. And this one is supposed to be deducted. So put it in 80 million. So what you have to understand from here is that some of these figures, if you add this one plus this one, those are giving you 100 million. If at all this goodwill was maybe 180 million, it means after deducting this one of 20 million, after deducting this 20 million, what remains is what we use to offset this. Remember, our impairment is 150 million. If let's say this one was 180, and we have already deducted the 20 million from here, it means we are remaining with only 130. If this one was 180, only take the 130 and we remove the rest. But of course, it is a bit rare for you to be given that question, but I'm just giving you what you have to get. It's not a must that you are supposed to go through all these items. You may find that the impairment they have given you is not much. Maybe the impairment was only 50 million. And after you offset this 20 million, you are remaining with 30. And you come to this one when it is already 80. So you give the balance, and this balance you will take it to the balance sheet. Of course, it will be given this side. And you end there. You ignore this one because you don't have the impairment you are going to be distributing. Hope you have got that. So we said this one is not going to be, so that one we can put a 0, and we put its carrying amount. We can actually transfer its carrying amount, 200 million. We say that one has no problem. We don't subject it to, because we have already dealt with it under IS2. Then, now since we have finished, we've done the damages, we've done the goodwill, now we are going on this one, the pro rata basis. So the totals we are looking for, now we are looking for totals for the remaining impairment loss. Let's first compute that. Remaining impairment loss will be got from our total impairment is 150 million. We less what we've actually used. We've so far used 20 million plus the 80 million. That's what we've so far used. This will give us a figure of 50 million. And now this 50 million is going to be our remaining impairment loss. We have also to compute the remaining assets. Remaining assets, now they are the ones we are computing. Remaining assets. Of course, the remaining assets will have a total of, we are adding the buildings we did not tackle them. They are 320. We add the 20 million that is the balance from this motor vehicle, because we only removed the 20. We are still remaining with the 20 or so. Then we also add the PPE, which is 60, and we also add, we said inventory, we are not going to include it there. Hope you can be able to understand that we are not putting inventory there because it's not supposed to be subjected to impairment. We have already dealt with it. So those are the ones that are still remaining. So this will give us a total of 400 million. And this 400 million, now we are going to be computing the impairment loss for each item. Maybe this one we may put a table. Maybe you can put a boundary. You can put this outside the pink borders. We'll be able to see what we are doing. So we try to look at now the building. Remember, we said these remaining assets, they are going to be treated using pro rata basis. And we say the pro rata basis will get the cost of the building, which is the individual cost or the individual carrying amount, which is 320. We divide that figure by our total, which is 400 million. Total of the remaining, then we multiply by our remaining impairment loss of 50 million. And this will give us 40 million. And this 40 million is what we are going to be taking to our impairment loss. This one of 40 million, term in regards for buildings, it's going to be 40 million. Meaning if it is 40 million, on this one, we've now, on the 50 we've removed, now we are remaining with only 10. because this plus this is already 180. Sorry, is 100 million plus this, that's 140. And we are only remaining with that. So we go to the PPE. Need me to use that PPE. PPE was 60 million divided by the total 400 million. Then we multiply by the figure of the impairment, the remaining impairment loss of 50 million. And this would give us, this will give us 7.5 million. And this 7.5 million is what we shall take to where there is PPE. This is 7.5 million. Then when you are done with that, then we have also to go to the next item, which is now the motor vehicle. Remember, this motor vehicle now is going to be the balance that remained, which is 20 divided by 400 million to multiply by 50 million. And that will give us a figure of course, we are remaining now with the 2.5. Because it was 10 million, we removed the 7 million, meaning the 7.5, meaning we are remaining with that. So it is this where we are going to be adding the 2.5. And when you add the 2.5 plus the 20 million, you will be able to get 22.2. You'll be able to get 22.2. 22.5 million. So now that 22.5 million is what we are going to be using as impairment. So we start lessing this one minus this one minus this. What you will get will be there. When we less 320 minus the 40, we are getting 280 million. Then the 40 minus the 22.5. We are making the 17.5 million. Then when we go to 60 minus the 7.5, remain with 52.5. Then the last one, of course, the goodwill is 0. We are deducting 80 minus 80, that is 0. This will give us a total of 550, which is the recoverable amount which they gave us. So when you add the whole of this, you will be able to get 150 million. But that 150 million was supposed to be deducted since it was the total impairment loss. So when you deduct this 700 minus this, you'll be able to get this 550. So that's actually what they wanted us to do. And they wanted you to be able to show how the distribution is going to be done, or then this one you can say impairment of a cash generating unit, that is CGU. And that one is done. Maybe to remove these grid lines. Yeah, you'll be able to see everything right there. So that's all for now. Then in the next one, we are going to be looking at, actually it will be the one that is closing our impairment loss, impairment of asset, that is IS 36. This will look at the reversal of impairment. What do we mean by reversal of impairment? Reversal of impairment is mainly arises in a sense that the asset had a previous impairment loss, but this time around, the asset is not going to be impaired. It's going to be having a gain, or it has been revalued upwards. Meaning revaluing them upwards, it means that now the recoverable amount is higher than the carrying amount. So we have an income. So what will happen is that if the asset had a previous loss, impairment loss, and this time around it is having a gain, then we have a problem there, because it will need you to, what the standard says, if the gain is to be there, then that gain shouldn't be or shouldn't exceed what the asset or what gain the asset would have had if at all the impairment didn't occur. So those are the things we are going to be looking at in the previous. So in the next video that's going to be dropping soon, and that's where I want you guys to make sure you focus a lot, because it's a bit tricky and we need to understand it, because it attracts the attention of these examiners, because it gives students a bit of a challenge of how you're going to be recording those figures. But it is very simple, so long as you watch it and complete everything, you try more numbers, then you're good to go. That's basically what I wanted to share for today. Make sure you subscribe, highlight, you can share these videos, you can comment. If there is something you didn't understand, make sure you ask. The WhatsApp numbers, they are there. You can get in touch with me and we'll be able to guide you through. So that's basically what we have for today. Until we meet again. Bye for now.